Good afternoon, and thank you everyone for joining today. My name is Colleen Bentley. I'm the marketing manager here for Private Vista. Today we have one of our advisors, Matt Parenti, with us, and he's going to be presenting on real estate opportunity zone investments. So Matt is going to discuss why opportunity zones are being talked about so much right now and how to determine if this sort of investment is right for you. So before I get started, a few housekeeping items. The first is that we will have a recorded version of this. So everyone who registered will receive an email with a full recorded version in case you want to reference any of the slides that are presented today. Second, we will be answering questions at the end. So you can submit questions at any point during the presentation, and that will be on the right-hand side of your screen. The questions will only pop up to us. And if you have any questions that are specific to your situation, you can contact us directly, and we'll provide more information on how to do that at the end. And then lastly, in case the phone cuts out at any point, just stay on the line. We will dial back in and keep the presentation moving from there. So that being said, I'm going to turn it over to Matt to get started.
Thank you, Colleen, and thank you everyone for joining us today. As Colleen mentioned, my name is Matt Parenti. I'm a senior advisor here at Private Vista, and I'm on our investment team, which looks at a variety of different investment products and different investment fields. Today we're going to discuss one such investment space that our team has been looking at, and that is opportunity zones. These have gotten a lot of press due to the tax benefits and timeliness, both of which we'll discuss throughout this presentation. So opportunity zones are a new opportunity for investment with large potential tax benefits, but also some complications we want to make sure we address today. The purpose here today is to walk you through the background of opportunity zones, the pros and cons, and who they might be a good, suitable investment for. By the end of today, we hope to equip our clients and friends listening with the knowledge they might need in evaluating this space, and hope you'll think of Private Vista as a trusted partner going forward in opportunity zones, and a resource for anything you might need. It's important when thinking of any investment to be properly educated on its intricacies, and certainly with something as complicated as opportunity zones, this is no different. So today's topics, we're going to talk about what are opportunity zones, what are the benefits and potential disadvantages of investing in an opportunity zone, who are these products suitable for, if you wanted to get invested, how would you proceed in doing so, and lastly, we're going to be happy to field any questions or comments you might have. Please feel free to submit those as the presentation proceeds, and we'll try to get to as many as we can, time permitting. So we're going to start by just going back to the beginning, and we don't have to go back too far because this is a newer space. So the idea really was conceptualized by a man named Sean Parker. You might recognize that name. He's the founder of Napster music sharing, and he's the former Facebook president, and he's also involved in a lot of different technology companies and projects in Silicon Valley. Being an early investor in a lot of technology companies, he had and still has a pretty substantial amount of holdings that have very large unrealized gains to the tune of several $billions. And you know, like anyone with very large unrealized gains and positions that take up the majority of his investments, he was looking for a way to get out of those with not paying a huge amount of tax that would be associated with liquidating securities with large unrealized gains. At the same time, he thought about the post-financial crisis economy and how a lot of communities around the United States hadn't taken part in the run-up, both from a technology standpoint but also an economic development standpoint, and thought there must be a way to create some tax benefits for people like him or people with unrealized gains, while also benefiting some areas that haven't seen quite the economic investment that others have seen. So he met and worked with two senators in the U.S. Congress, one being Tim Scott, a Republican senator from South Carolina, one being Cory Booker, a Democratic senator from New Jersey. Tim Scott is the gentleman on the right, Cory Booker, the gentleman on the left. And the three of them and a team of others were looking to pair or partner investors with very large unrealized capital gains with communities which missed out on economic development post-2008. They looked to draw some legislation putting those two things together. The three criteria for the legislation they would be proposing is, number one, the money had to be invested into qualified areas. They didn't want the money just going to areas that had already benefited from the economic run-up. They wanted this to really take care of areas that have not benefited from a good economy. Second, they wanted the money to be for new projects in construction or substantial improvement to existing properties. One of the rules that they ended up rolling in was that 100% of the cost of any property would need to be invested into the project or development. This all so that the money isn't just going and sitting in as a tax haven, but it's actually being put to work and put to good use towards what they're trying to achieve, which is the development of some underdeveloped communities. The third criteria that they had for investment was that the money had to stay in the community for 10 years in order to receive any benefit. This, again, so that the money didn't just go in very quickly and come out just for the tax benefit. They really wanted this to work. And we want to pause here and just say, I think we're all happy to see some bipartisan legislation come out of Congress, because no matter what side of the aisle on, I think you'd agree it's been rare these days. So we're very happy to see that. Anyway, the legislation passed in 2017. It was tucked under the Invest in Opportunities Act as part of the Tax Cuts and Job Act of 2017. And in early 2018, each governor of each state went back and designated individual qualified opportunity zones within each of their states. In a minute, we're going to get into what criteria they used to select those opportunity zones, but each governor went and picked those out. The map, which you see to the left, was published in May of 2018. And between May of 2018 and early 2019, there wasn't a whole lot of movement on the opportunity zone investment, just because there was a little bit of a lack of clarity in this legislation as to the specifics of some tax benefits. So in October 2018, there was a round of legislative clarifications that begin to clarify how this investment space would work. And then in April 2019, the second round of legislative clarifications went through. And at that point, things really clarified and money started to roll into these spaces. And as we've seen a big tick up in the media coverage from that point because money moving into that space. So what this all means is that now that there's some IRS clarification, both investment companies and investors are willing to proceed and move forward, and that's where we are today. Now we're going to look at what actually constitutes as an opportunity zone. So I mentioned governors had to go back and draw these individual zones, opportunity zones up for their individual states. What were those? Well, each zone would have to have a poverty rate of at least 20%, and the median household income could not exceed 80% of the metropolitan area's median household income. This was all based off metrics in the 2010 census. So that was the most recent census taken. All told, there's over 8,700 opportunity zones now in the United States. And importantly, for a tax benefit for this that we're going to talk about in a little bit, each opportunity zone is designated as such until the year 2047. For those of you listening around the country, Private Vista is based here in Chicago, so we wanted to provide an example of an opportunity zone near us. And you can see from the picture to the right, this is on the south side of Chicago, 87th and the Lake. It was home to the U.S. Steel plant for a number of years before that plant was bulldozed, and the lot has sat vacant for a number of years. Both the city of Chicago and the state of Illinois have long tried to spur some investment on this prime piece of real estate, but have thus far been unsuccessful. So they're hoping that with the help of opportunity zones, that some money will begin to roll into this area, and development will proceed. So there's many different structures an opportunity zone investment could take, and there's also a lot of individual investments that could be tucked under those different structures. And it's important to be disciplined when looking at those types and structures to find what's right for you if you were to proceed with investing in an opportunity zone. So first, an individual could go in and, if they wanted to, buy property in an opportunity zone, and we would find this to be probably the most difficult way of proceeding for a number of reasons. Number one, we mentioned earlier that you would need to invest 100% of the cost of what you pay for the property into the property. So number one, this would be very expensive. And the second thing is, we mentioned your money would have to be in there for 10 years. You'd have to develop and then manage the property. And so this could also be very time consuming. Thirdly, we would note that our only recommendation, if you were to ever proceed with buying property outright in an opportunity zone, would be that you have experience in developing and management. But there's some easier ways it could be done. Number one, you could invest in a partnership structure where an investment company or a developer is a general partner, and they seek to add limited partners as investors in their property or properties. Another way is a real estate investment trust, or what's called a REIT, where the investment company or developer will create a portfolio of property or properties for investors to buy shares into. As I mentioned, there's many different types of opportunity zone investments that can be tucked underneath these structures. It could be commercial real estate, residential real estate, industrial, farm, and even stadiums. It's certainly not limited to these, but these would be the most popular. So next we're going to step into really the most important part of opportunity zones, and that's the tax benefits and implications. There are potentially substantial tax benefits for investing in opportunity zones, and they're layered in three different ways. So we want to slowly walk through what those are and then provide you with an example, including some real numbers. So this chart to your left is going to be a timeline of the various tax incentives that come in over a 10-year period. We're going to delve into each of those individually. So first, what would happen is you would realize a capital gain from an investment. It could be a stock, it could be a mutual fund. We'll get into what assets you could sell, really anything with a capital gain in year one. So in this case, 2019. You could take a portion or all of the gain from the liquidation of that investment, and you'd invest it in an opportunity zone within 180 days of the sale. And rather than pay capital gains tax on the sale of that investment, if you put it into an opportunity zone, that tax gets deferred for 7 years. So you're not paying any tax for this sale in 2019, year one. After 5 years of being invested in an opportunity zone fund or opportunity zone, your original capital gain obligation from the year one sale is reduced by 10%. Then, after 7 years of being invested in an opportunity zone fund, your capital gain obligation is reduced by an additional 5%. So by sitting in an opportunity zone investment for 7 years, you've reduced your year one capital gains tax obligation by 15%. In that 7 years, we mentioned earlier that your tax is deferred for 7 years. In that 7th year, you will pay capital gains tax on the original sale from year one, but again, you've got the 15% reduction. After 10 years of being in the opportunity zone investment, you're eligible to liquidate, and any capital gains on the investment in the opportunity zone, any capital appreciation, is not taxed from a capital gains perspective when you go to sell it. I do want to note that any income you earn from the opportunity zone investment, it could be taxed along the way. So for instance, if I invest in an opportunity zone and it appreciates from a capital gains perspective, when I sell it, I won't pay capital gains tax. But if the property is earning rental income, you will get taxed or could get taxed on that. I should note that if an investor removes money prior to 10 years, the tax from year 7 is due immediately, and the additional tax benefits are lost. One of the most powerful tax incentives for opportunity zones that isn't listed on this chart goes beyond year 10. So that's the idea that the capital appreciation on your opportunity zone investment is not taxed when you go to sell it. Now, we mentioned earlier that opportunity zones are labeled as such until 2047. So theoretically, you could invest in an opportunity zone in 2019 and hold it till 2047. And when you go to sell that investment, you are not taxed on the capital gain. So this has some really huge long-term capital gains benefits were you to invest. And I should mention, should the property succeed. We're going to go through an example of what this investment would look like with some real numbers, but I want to note beforehand that the capital gains rate that we're going to use is current capital gains rates, which are subject to change. In addition, we're only looking at federal capital gains, federal capital gains tax. So each state has different rules for capital gains tax. We've got folks watching in Illinois, Colorado, California, and all over the United States. We didn't want to use any state tax as part of this calculation. So in year 1, 2019, let's say, for instance, I sell $1 million of my ABC stock, and my original investment in that ABC stock years ago was $500,000. So I've made $500,000 on my investment up until 2019. I liquidate it, and within 180 days, I move part or all of that gain into an opportunity zone fund. For the purposes of this example, I'm going to say I rolled all of it, the $500,000, into the fund. Now, ordinarily, if I wasn't to invest in an opportunity zone, I would owe about $100,000 of tax, capital gains tax. Using a 20% federal capital gains tax rate times the $500,000 gain, that's $100,000. But because, again, I invested in an opportunity zone fund, any tax from that sale gets deferred until year 2026 or year 7. So we get to 2024, which is year 5, and the $500,000 a gain from my ABC stock now becomes $450,000 a gain because I get a 10% reduction. Now we move to 2026, year 7, and the $500,000 a gain now becomes $425,000 a gain for tax purposes. And because it's year 7, this is where I'm actually going to pay the tax on this year 1 sale. So I would owe $85,000 of tax, the 20% federal rate times $425,000 of gain. One thing you would note here is, first, I've saved $15,000 of tax over a period of 7 years. But there's some additional benefit in that because I didn't have to pay tax in year 1, where I'd owe $100,000, I could have invested what I would pay in tax for those 7 years and earned some money. So there is some inherent value to the deferral. Then in 2029, after I've been invested in my opportunity zone for 10 years, I'm eligible to liquidate my $500,000 opportunity zone investment. And when I go to sell it, I do not have to pay capital gains tax on any appreciation. So for example, if that $500,000 investment grew to $750,000, I walk away $250,000 tax-free. Again, if I were to liquidate before the 10 years is up, I would have to pay that year 7 tax and would lose the tax benefits. There are some caveats to the tax benefits that one should be aware of, and they relate to the timing of the investment, so we want to touch on those. In our example, we invested prior to 12/31/2019, so an investor that did that would be eligible for both the 10% reduction in 2024 and the 5% reduction in 2026, so 15% total. An investor who invested after 12/31/2019 but prior to 12/31/2021 would only be eligible for a 10% reduction. So there's still some reduction benefit, but by not investing by the end of this year, you do lose 5% of the reduction benefit. If you're to invest in an opportunity zone after 12/31/2021, that will eliminate the 15% capital gain reduction benefit. But I would note that an investment in an opportunity zone still is eligible for the appreciation benefit of having the benefit be tax-free when you go to liquidate the investment after 10 years. As I mentioned in our last slides, it doesn't only have to be a stock or a mutual fund or investment security that you sell that has a capital gain. It can really be anything that has a capital gain, real estate or business, etc. So what are the benefits? Well, we just walked through the main benefits, which are the tax breaks, and there's 3 layered in. So first, the deferral of capital gains. Second, the reduction of the capital gains tax obligation. And third, the opportunity for growth of capital without tax on opportunity zone gains. Really, the third being what could be the most substantial of the tax benefits, especially if, as we mentioned, the investment was held beyond the 10 years and the property saw significant capital appreciation. An additional benefit would be portfolio diversification, because it is unlikely that an investor would have any such property in their portfolio. So this would be a way to invest in something that one might not have anywhere else in their investment or real estate portfolio. There's a couple of disadvantages we wanted to discuss. First being, this is a 10-year minimum commitment. So this isn't something that you can move money in and out of easily. And again, if you were to, you would lose some of the tax benefits. Second, there are some tax and reporting complications to investing in opportunity zone, mainly being that the IRS does not keep track of individuals' timelines for investment. So if we were to go back and look at that timeline of where those tax benefits took place, the onus is on the individual investors to keep track of those benefits. And so working closely with your tax advisor and your financial planner, if you were to invest in an opportunity zone, will be critical to make sure that you're filing correctly and getting those benefits at the time when you're eligible. The third would be management fees. So in our research, our investment team's research, we found that the management fees for opportunity zone funds are a bit higher than what you'd find in publicly traded REITs or even privately traded REITs. And what we found is the fee structure is more closely related to what a private equity or a hedge fund might look like. Another potential disadvantage is that opportunity zones don't have much historical track record that we could look back on for performance history. while we're looking for real estate managers and developers that have experience, this is an area where not many have gone before. This is a newer investment, so it's hard to say how it will perform going forward. There are some estate planning complications. I would note, most importantly, that this is illiquid, and there is that tax due in year 7 no matter what. So a portion of the estate would need to remain liquid in order to pay that tax. And because that sale the year 1 sale would take place in the original investor's life, they wouldn't get a step up in basis on that original sale because it already happened. One of the things that we'll discuss in the slides going forward that could be a disadvantage is many funds have investor eligibility requirements and or high investment minimums. And lastly, there is inherent risk in investing in economically sensitive areas. That could be a potential drawback. So who might opportunity zones be a suitable investment for? Well, maybe you're someone who has a position in your portfolio, or you've got a piece of real estate that has a very large unrealized gain, and you'd like to get out of it, but you haven't wanted to pay the tax on it, or maybe you want to diversify, or maybe you just don't like the investment that you're in. One way to maybe defer and avoid some of that tax would be an opportunity zone. It would be right for someone with a long-term investment horizon. Again, the minimum investment is 10 years, and the largest tax benefits come over the longer period of time. So would recommend this for folks with longer-term investment horizons. The other thing we mentioned is, if you were to invest in an opportunity zone, it would be important to have other means of liquidity. Again, this 10-year lockup comes up where you're not going to be able to access the capital that you invest in an opportunity zone. In addition, that year 7 tax payment that we discussed has to come from somewhere, so either cash or somewhere else in the portfolio. One is not going to be able to liquidate any part of this investment in order to pay that year 7 tax. We mentioned that some funds have eligibility requirements, so an investor would need to satisfy net worth and eligibility requirements. A couple of the requirements that we've seen, number 1 would be an accredited investor. This would mean the investor would need to have at least $1 million of net worth, excluding their primary residence, or annual income of at least $200,000 for an individual, $300,000 for couples. That income would have to have taken place in the last 2 years with the same expectation in the current year. The other would be a qualified client. This one states that one would need to have $2.1 million of net worth, excluding their primary residence. So what's Private Vista's philosophy on opportunity zones? Well, we've looked at over 120 different opportunity zone investments, and we continue to look at the space very closely and monitor any new rollouts from the IRS perspective. But in addition, because this is newer, we've seen a lot of new funds come online, and so we're monitoring those as they come out. But really what we're looking for is quality investment opportunities. We have a saying around here that is, don't let the tax tail wag the investment dog. So we've been reviewing this for the last 18 months or so, and we don't want to just offer up an investment opportunity just for the tax benefit, because a bad investment could wipe out some of those tax benefits. So we're looking for managers with experience in development and management of properties. We've noticed in the many opportunity zone funds that we've looked at that some have been newer to the game, and we'd like to avoid those ones just because this is a newer space, and we'd prefer to have people that have the experience in development and management, and specifically if they've got development and management experience in zones. So just wrapping this all up before we get to questions, we wanted to give you some key takeaways. First, opportunity zones have really some large potential tax benefits if one was to invest. but there are also some complications and drawbacks that people need to be aware of and think about prior to making an opportunity zone investment. Really, we would stress that finding a good investment opportunity is more important than just looking for the tax benefit. And lastly, we've done a lot of research on this, and we've got a very qualified team looking at opportunity zones. So we hope that if you are interested in this space, that you come to us as a primary navigator for the opportunity zone space and any questions that you might have about this sort of investment. So with that, we are going to take a couple of questions. Let's see here. Let's see. What if the capital gains tax rates change? So if the capital gains tax rates change, that will impact what you pay today versus later on. So we mentioned in year one, you technically for an investment not going in an opportunity zone, you would pay today's capital gains tax rate. In year 7, you're going to pay capital gains tax at the rate in that year. So there is potential for that to go up, but I would note that really the primary benefit is the longer term benefit of no capital gains tax on appreciation of property. Can I invest specifically in one zone, such as the Chicago property that you mentioned? We're deferring that to the managers. So, any investment fund that we use, they're going to select the properties that they invest in, and not us. Is it appropriate for an ideal age? We would recommend this for somewhat younger clients. I wouldn't rule out anyone, so I'd defer that to how healthy the individual is. But remember, there are estate complications for investing in this sort of fund, and while nobody wants to pass, passing while this investment is open or in that 10-year window, complications do arise. Do you recommend using a CPA with this type of investment? Yes, definitely. While if you were to partner with us, certainly your financial advisor would help with keeping a timeline and certainly monitoring the investment. We would stress that it would be really important to work with a CPA on this one because, again, the IRS does not monitor individuals' timeline for investment. So it's important that each individual keep track of that with their CPA. Is there a limit to the amount of leverage the funds can use? Each individual fund has its own leverage usage. I won't go into the specifics for the two that we're using. I would recommend talking to your financial advisor more specifically about those products. But I would mention that is something that typically funds limit. We are running a little short on time, and we've got like 5 or 6 other questions that we weren't able to get to today, but I would really recommend forwarding anything that comes out of this presentation today or anything that we were unable to answer to your financial advisor, and they'd be happy to help you. So if you're a client, please contact your advisor for more information. If you're interested in working with us, you can email us at privatevistanews@myprivatevista.com. And we're always putting on educational webinars and events, and we'd be happy to have you sit on some of those. So if you'd like to get on our mailing list for information about those, again, that's privatevistanews@myprivatevista.com. We really appreciate everyone's time today, and I'm sorry that we couldn't get to every one of the questions, but we wanted to keep this within about 40 minutes. So thank you again so much, and enjoy the rest of your week.